Hey traders, it's John Fortune here with this week's weekly Forex Forecast. I hope you're having a fantastic weekend. Next week is a huge week for the markets. We have FOMC on Wednesday, and this event combined with the CPI print on Friday paints a bit of a bleak picture for stocks, and it does look like we could have a big risk off move coming. The good news is the scorecards have set up to allow us to play FOMC both ways. However, as we go through today's video, I'll discuss with you the reasons why I think we're more likely to get a big risk-off move potentially next week from FOMC. Okay, so let's start with the economic calendar as we always do, and we cannot go into next week without having a look at the economic calendar, understanding what happened last week and what's coming up this week. We did have an interest rate decision out of Australia. They did give a surprise hike, but it's going to all be about FOMC on Wednesday. You can pretty much put this in the rearview mirror because what happens on Wednesday next week out of FOMC is really the key to what's going to unfold in the markets. If we scroll down, you can see we also had an interest rate decision out of Europe. And although they came out fairly hawkish, at least relative to their previous rhetoric, we saw the euro sell off on the event itself, and that was only compounded by the CPI print, which came out on Friday. And the reason the CPI print, which came out on Friday, is extremely important, and in fact, I can see they don't have the exact data on this specific calendar, but the print came out, I did tweet it, at 8.6% inflation in the US, and it was expected to come out as it previously came out at 8.3. So if it came out previously at 8.3 and it was expected to be 8.3 again, essentially the expectation was that inflation had peaked. However, inflation actually increased last week when we had the CPI print on Friday. And this CPI print, which came out on Friday at 8.6%, is the key to understanding what's most likely going to happen next week and in FOMC on Wednesday. So if we just jump ahead to the upcoming week, you can see we have a bit of PPI data, some retail sales data, but this is the major event which is likely to dictate future moves in the markets. And we are expecting a 1.5% interest rate or Fed funds rate target, and this would be an increase of 0.5%. However, with the overshoot in inflation and the increasing of inflation last week and the print on Friday of 8.6, there is a risk now that the Fed comes out with a surprise rate hike, and instead of the 0.5% hike, which is currently expected, we could see 0.75. Some people are even calling for a 1% hike to get inflation under control in the US. And it's because of that we saw a rally in the dollar at the end of last week. And I tweeted previously, even 3 months ago, that the Fed is not going to pivot with 8% inflation. Anybody looking for a Fed pivot is going to be disappointed. This is not 2018. And in my opinion, on Friday, that was when market participants in general finally realized that this is in fact going to be the case. And far from a Fed pivot on Wednesday, we're more likely to see, at the very least, a 0.5% interest rate rise as expected, and even possibly more with an unexpected rate hike to control that inflation. So we do also have the SNB, and we also have an interest rate decision out of the UK. But as I said, it is really FOMC next Wednesday, which is likely to dictate the markets, not just in Forex, but also stock markets. Okay, so let's have a look at the scorecards for the coming week. And the great thing about the scorecards this week is, although my base case is for a more hawkish Fed, for potentially, if we don't get an unexpected rate hike, I think we could still see the Fed, even if it just raises the rates by 0.5% as expected, it could come out with more hawkish rhetoric, could decide, well, we're not going to unexpectedly raise rates because this could actually cause problems in the markets. What we'll do is we'll come out with a 0.5% rate hike, but we will jawbone a bit and we'll actually talk more hawkishly instead of giving a surprise rate hike. So that's a possibility as well. Either way, I think we're going to see the dollar benefiting from FOMC next week. And so dollar strength plays, especially as they're top of the leaderboard here, especially US dollar versus, say, the pound, the euro, New Zealand. Also, we can look at Swiss franc, potentially US dollar, Japanese yen. Those are going to be my primary setups that I'm going to be looking for next week after FOMC. And just bear in mind, the markets are probably going to do nothing between Monday and Wednesday, probably just going to correct or chop into FOMC. So for reasons discussed when we looked at the economic calendar, I am favoring dollar long plays next week as my primary setups. However, what we can also do here, which is great the way this is structured, is if that were to fail to materialize, you would see the Australian dollar benefiting from a weaker dollar, more than other currencies. And that would perfectly allow us to set up a plan B here with, say, the commodity currencies of the Australian dollar and the Canadian dollar versus especially the safe haven assets like the Swiss franc and the yen. So we will also, in today's video, not just be looking at US dollar long plays, which are my primary setups, but we're also going to look at a backup plan if that fails to materialize. And that backup plan will be, for example, Aussie franc to the upside, Aussie yen to the upside, CAD franc to the upside, CAD yen to the upside. And we'll also be looking at a couple of other setups such as pound CAD, pound Aussie to the downside as well. Okay, so let's look at the individual currencies, starting with the US dollar index. The 102.992 is the major 7-year breakout level, which I've highlighted in previous videos, and also that's what I wrote the Twitter thread on with the DXY breakout. I post a link in the description, and I believe in the comment as well pinned to this video. You can find the thread for those of you who want to read it. However, we broke back above the 102.992 last week, and we broke above this with momentum. Now, in previous videos, I had highlighted that we should be treating this simply as a correction. And I said to you, this is not how markets tend to reverse. This should be treated as a correction. And the fact we've broken back above the 102.992 with momentum, as traders took the view, which I just outlined in this video today, that inflation has not peaked. Inflation is in fact increasing. Therefore, the Fed are going to have to get even more hawkish than they currently are, which is pretty hawkish. And in fact, the move to the upside in the dollar index last week was strong enough really to be considered. This, you're seeing some flight to safety here. You're seeing money coming into the dollar on a bit of fear, because you can see the way this just broke up over 2 days, 1, 2, and in those 2 days, we pretty much covered the majority of the overall down move over here. Now, the big thing to watch with the DXY next week is when we take out this high. Why? Because we have a major multi-year 7-year breakout at the 102.992, and this is essentially a retest, although it's a deep retest, of this major breakout level. And what happens is when you trade into this, you get people, they're not looking at the bigger picture, they short DXY, they place stop losses up in this area, and that actually provides fuel for momentums, because all of the people who shorted here, they start to panic, especially as it comes back above the 102.992. You see people pulling stops here. They're the ones that get out early, and that causes momentum to the upside. And the rest of them, especially the ones that sold at the low here, they don't want to take the loss on this, but they do have stop losses over here. And when this comes up and takes out the high, we could see this breaking with capitulation to the upside. We could see stop losses coming out. We could see short covering, and that is the fuel that is required for bigger breakouts. So we ask ourselves a question, well, is the dollar in a position fundamentally where we could see a much bigger breakout of a 7-year consolidation? And the answer to that is actually yes. There is a catalyst, a macro catalyst, and that is that the Fed is behind the curve. Inflation is actually not peaking, it's increasing, and the Fed is going to have to get even more aggressive than people thought in order to get this under control. That is the exact macro drop you might expect if you were to see a true 7-year breakout in the DXY. So keep an eye out for this next week. This is something that I've been keeping you guys updated on and posted about ever since we broke the 102.992. FOMC next Wednesday, especially with an unexpected rate rise or a more hawkish Fed than expected, could be the catalyst to break this 7-year consolidation, and we could actually see some real strength coming into the DXY next week. So I do favor dollar long positions next week. Next is the euro. Now, in previous videos, I highlighted the major breakout, multi-year breakout of the 1.06710. This is essentially the euro version of that major 7-year breakout we saw in the DXY. And unless we can come back above here, I said in previous videos, and start trading above this with momentum, this is the start of a major trend to the downside in the euro. And in previous videos, we came up and we consolidated above this. And I said to you, one of the rules of trading is you don't buy support in a downtrend, and there's likely to be stop losses in this area. The same kind of setup for euro, dollar, and silver, which we're going to look at. And I said when this breaks down and these people get taken out, very similar, in fact, pretty much just the opposite of what I just discussed in the bigger version with the DXY breakout to the upside, we saw kind of a mini version here of stop losses being run and capitulation coming in. There's a very good chance this now comes down, and this failure of the 1.06710 could in fact be the start of a much bigger trend to the downside in the euro. And if the euro cannot rally and gain strength from a more hawkish ECB, when you add into the fact the inflation miss on Friday and the fact that the Fed in all likelihood are going to get even more hawkish on Wednesday, that is the catalyst for this to fail and for further declines in the euro. So any pullback in the euro, I am looking further declines down to the 1.02960. Next is the pound. In previous videos, I highlighted the fact we traded into this resistance level. I said I was looking for further declines and we started to break out. So any pullback now in the pound is viewed as an opportunity to look for further declines down to the 1.2081 and then on to the 1.1734. Next is the Swiss franc. Now the Swiss franc was a market which had some near-term strength, but I did say to you that this really is just setting up as a big bear flag, and I'm expecting this to come down, possibly even to the 0.98690. And for that reason, I didn't trade the Swiss franc pairs, even though they were showing a little bit of, I think it was bullish to neutral in last week's scorecards. We just left these out altogether. The Swiss franc is now declining, and this looks like it's set for further declines. Next is the yen. Now previously I noted we were coming back to try and retest the major breakout level here. However, we got a sign from the scores to start to be short yen once again a couple of weeks back, and it failed to retest this and it came down. The problem with the yen is, if we are approaching a global recession, as I've tweeted about over the last few months, the yen historically catches a bid as a safe haven asset in that scenario. And you could see this snap back quite violently if we start to see some capitulation in the stock market. So I am interested in yen shorts, but I would prefer to trade those if we saw the dollar reversing or for whatever reason we saw a more dovish Fed. That's why the yen pairs like Aussie yen, CAD yen, these are more of a plan B, because my expectation is for a more hawkish Fed, not for a more dovish Fed. Next is the Canadian dollar. This is a market we've been relatively trading to the upside, even though it's kind of been neutral overall. And look at this sell-off last week out of the Canadian dollar. If this comes down, continues below the 0.77650, this actually could start a brand new trend to the downside, breaking out of this consolidation. And that would be one of the first signs that we could be getting close to a capitulation and a crash in the stock market. Why? As it currently stands, the commodity currencies like the Canadian dollar, like the Australian dollar, like the Mexican peso, they've been holding up, which is a sign that inflation or stagflation is still the current economic condition as opposed to deflation when you get those market crashes. If the commodity currencies start to roll over, that really is the canary in the coal mine that the stock markets may be about to crash. And based on what we saw at the end of last week in the Canadian dollar, despite the fact we have strong crude oil, this is not a good sign. But it is still a little bit early to make that call yet. I would like to see the Canadian dollar breaking down and even taking out the low over here. That would really be the time when we could see really big problems in the market. And of course, in that scenario, what happens to the US dollar? Explodes to the upside. So again, CAD pairs to the upside are on my list, but they're a plan B, and I won't be trading them if we get a strong dollar. Next is the Aussie. Aussie tested resistance and now we're starting to sell off. Again, just as I discussed with the Canadian dollar, we are now starting to see what was recently a relatively strong commodity currency starting to sell off. And this may be an early warning sign of stagflation turning into deflation. So again, I am going to be long the Australian dollar because relatively it's one of the strongest currencies in the scorecards, but only if we see the DXY falling and we get a reversal in the DXY. And so Aussie long positions are only a plan B. And finally, we have the New Zealand dollar. Big bear flag. I have been looking for this to come down. Further declines are now taking place. And New Zealand shorts are something I'm interested in next week, especially versus the US dollar if we get a more hawkish Fed. Okay, so let's have a look at the markets themselves, starting with crude oil. Now, crude oil is still bullish, and with this in place, this is most likely signaling we're going to have stagflation. However, notice the price action at the end of last week when we had that inflation print. That sell-off there in crude oil, again, it's a little bit early to say. I don't like to pick tops or bottoms, as many of you will know. And I would really like to see crude oil coming down below the 113.710 as another sign that we're turning from stagflation into deflation. As it currently stands, I am bullish on crude oil, although I don't think I'm going to be trading crude oil next week because of FOMC. Any pullback in crude oil is going to be viewed as an opportunity, perhaps after FOMC, to look for a bullish breakout into the 125.95. Next is Euro-Dollar. Euro-Dollar is my favorite market heading into next week because it's the currency in terms of the euro which is most exposed to the US dollar. So if we do get a hawkish Fed, or we get a more hawkish Fed than expected, or even a surprise rate hike, we are going to see the euro suffering as one of the most against the US dollar. Any pullback, and what I think we could very well see, is a correction into Wednesday, perhaps even a retest. And this was a setup I actually discussed last week. I said, look for the break below here, stop losses to be taken out, and capitulation. Look at this. That's exactly what we got. So any correction into FOMC is going to be viewed as an opportunity to look for further declines into the 1.0341. Next is pound dollar, my second favorite market, which is why it's highlighted in gold. We also had a breakdown at the back of last week, and any pullback in this market, I'm looking for a correction into FOMC, most likely, and I'm going to be looking for further declines into the 1.2081. And again, this is based around that scenario of the Fed coming out and being more aggressive than people expected because of the miss in inflation on Friday. And my third and final favorite pair heading into next week, and you can see all of my favorite pairs are dollar plays heading into next week, is New Zealand dollar. This is a commodity currency, and the commodity currencies tend to suffer the most against the dollar when you have risk off moves. And so any pullback in this market is going to be viewed as an opportunity next week to look for further declines into the 0.6158. Next is US dollar Swiss franc. Now, US dollar Swiss franc and US dollar yen are not highlighted in gold because these are both risk off currencies. So when you get, or if you get, a hawkish Fed or a more hawkish Fed and you get strength coming into the dollar, it's also going to provide some strength into other risk off assets. And so US dollar Swiss franc and US dollar yen, for those reasons, are not viewed as good as euro, pound, New Zealand in the scenario we get an unexpectedly hawkish Fed. But I would still expect US dollar franc to rise to the upside. So any pullback in this market is viewed as an opportunity to look for bullish setups into the 1.0049. Next is dollar yen. Now, first thing to note is that US dollar yen took out targets to the upside, and it finished the week at the third target. It also took out the previous high at the 133.740. The next thing to note with US dollar yen is if we break the 135.16, there's nothing but air, a huge gap between the 140.290, and you can run these kind of levels quite quickly when you get that scenario. The problem with US dollar yen is if we get an overly hawkish Fed and we start to see a flight to safety, historically you will see US dollar yen selling off. You see US dollar declining against Japanese yen because the yen has historically been more of a safe haven asset than the dollar, and that is because of the status of Japan as being the world's largest creditor. And so there is a little bit of a dilemma here with the US dollar Japanese yen pair. This is a good long all the time the markets are not in a flight to safety. And so I quite like US dollar yen to the upside the whole time the commodity currencies are holding their strength. If we see a big rally in the dollar and we see capitulation taking out the highs in the dollar index next week because of something the Fed says, I would not be looking to trade US dollar yen to the upside because I would be worried about going long, a flight to safety coming in as the stock markets in the US, for example, sell off. And that actually is going to, in all likelihood, see the US dollar declining against the yen. So I've left this in here so we can discuss that about the yen. However, it's my least favorite, and the chances of me trading it next week are very, very slim, especially as you're going to get opportunities in these markets if the Fed comes out and is overly hawkish. Okay, so what about if that does not materialize and for whatever reason we see a sell-off in the dollar because of something the Fed says next week? Although I think that's unlikely, what happens if that materializes? We want to be prepared to be wrong, let's say, and to trade this in the other direction. Well, Aussie yen took out the target last week. This has been a really good long. Ever since it broke out of this consolidation down in this area, I flagged this for long opportunities and we had a fantastic rally. Coming into this week, however, if we get a strong dollar, a breakout to the upside, an overly hawkish Fed, and this causes a sell-off in stocks, we could see a flight to safety, and that would see the Aussie declining against the yen. That's why these are plan B currencies in the event of a dollar weakening. And something as well that just caught my eye here is what is interesting here is we have this rally up here, this inverse head and shoulders. We have a very extended move up here, and this looks very much like a 1, 2, and a 3 wave for those of you who like your waves. Markets do not always move in waves, but they do appear. And if that was the scenario, I question, just thinking out loud, whether we get one more high up here for a fifth, and then FOMC causes this to double top and we get a bigger reversal on risk off or a flight to safety. So As a plan B, if we get a less hawkish Fed or we see the dollar selling off for whatever reason, any pullback in this market is viewed as an opportunity to look for long setups into the 96.93. Next is Aussie franc. This is a commodity currency versus safe haven asset, so this is a risk on move really. Any continued pullback on dollar weakness, let's say we get a breakout to the upside after FOMC, I am going to be looking for long positions into the 0.7122. Next is pound Aussie, not highlighted in purple because it's not one of my favorite backup trades, and the reason is because the pound and the Aussie would both benefit from a weaker dollar. But I am also going to be looking at this, and any break lower after FOMC like this, I am going to be considering this an opportunity to look for short setups into the 1.7174. Next is CAD yen. Took out both targets to the upside last week. CAD yen has been a fantastic long position, and I highlighted the breakout down in this area. We've been long all the way up here. We started to pull back last week as we got a little bit of risk off coming into the markets because of the inflation print. I question once again, is this 1, 2, big 3, and do we get a double top up here for a 4 and a 5 and then a sell off on a flight to safety and a hawkish Fed? Well, we'll wait until Wednesday, and if on Wednesday for whatever reason we get the Fed being more dovish than expected, or we see a reversal to the downside in the DXY, you would likely see this jump into the upside, and this would be the opportunity to look for long positions into the next key area resistance, the 109.56. So the purple ones here are my favorite backup trades for next week. And the final backup trade here, which I like the most, is CAD franc. Again, commodity currency versus risk off currency. We took out the target almost to the pip at the 0.77910. Any pullback and a breakout after FOMC is going to be viewed as an opportunity to look for long positions into the 0.7863. Okay, so wrapping up the video with gold, silver, and Bitcoin, starting with the gold-silver ratio, we're starting to break out to the upside. And what happens in a flight to safety? You see gold outperforming silver. Silver has been my preferred short in previous videos, and it has actually, as you can see from the gold-silver ratio, underperformed gold. And silver remains my favorite short out of both gold and silver going into next week. Next is gold. Now, gold and silver were interesting at the end of last week because we saw rallies in both of these markets on the inflation print, is that initial knee-jerk reaction. The problem is if we're going to see a flight to safety, gold actually tends to suffer because the dollar rallies, so that in itself is a headwind to a strong gold. But also you see gold being liquidated so people can cover margin in a capitulation. So going into next week, I do still favor short positions in gold, but I'm unlikely going to be trading gold next week. I'd rather short silver. Any break lower in gold, and I would like, we're testing resistance here, I would like to see this momentum peter out in case this is going to show a bigger breakout to the upside. I'd like to see this peter out and in fact start to reverse like this and break down lower. Any reversal lower in gold would be viewed as an opportunity to look for shorts into the 1789.28. Next is silver. Now you can see the inflationary rally in silver at the end of last week as well, just as we saw in gold. And look at this setup. 2145 is the major breakout level to the downside where we could see a big sell-off in silver. We came and retested it. And remember I said to you, just like the euro setup, look for capitulation. Well, in this case, there was no capitulation. But I can guarantee you, those who bought in this area are now placing stops here. And if this comes down and breaks the 2145 and then this low, you are going to see silver coming down in all likelihood to the 20.51. And of course, in any flight to safety, you will also see silver suffer. So I am bearish on silver, and silver is one of my preferred plays heading into next week. That's silver shorts. And the final market we're going to look at here is Bitcoin. And Bitcoin is highlighted in gold here. This is something I'm keeping my eye on. In fact, I'm already short Bitcoin. I tweeted this out last week as it was starting to break down. And I do think that Bitcoin could be on the verge of a real capitulation like this to the downside. Why? Because not only are we breaking out of this, but this is below the major breakout level of the 32,935 in Bitcoin, where a brand new trend can be formed in the bigger picture to the downside. So any pullback in Bitcoin is still viewed as an opportunity to look for further declines into, first of all, the previous low and on to the 24,307. Okay, so finally, let me just leave you with this chart, guys. Why am I talking in this video about a capitulation of flight safety in stocks? Two reasons. One, we are at the verge of a potential major breakout in the dollar index. And two, we go into next week with the Fed having to address an increase once again in inflation, with the potential for the Fed to get even more hawkish and aggressive. And for those of you who follow this video and have been following since April, you will know I posted at the time, and I put a video out, and this was in fact in the weekly Forex Forecast videos, that the Russell, when it broke the 1894, was potentially the start of a major trend change to the downside. And what have we had since? We've had a break, a pullback, and a retest, and this is where we go into FOMC next Wednesday. And this is where stocks currently sit, with the prospect of a hawkish or even unexpectedly hawkish Fed next week. And that is one of the reasons why I'm talking about a potential flight to safety next week. So that is it from me for this week, guys. As always, I hope you enjoyed this video, and if you did, please let me know by liking, sharing, and subscribing. A big thank you to everybody who does that on a regular basis, and a big thank you to everybody who has subscribed to the channel so far. I want to wish you all a fantastic weekend. I want to wish you all the best in your trading next week. The only thing left to say is take care, and don't forget to trade safely.